So why does a wealth planner want you to exit your business? Well, it's quite simple. When you have a private business, they cannot charge you any asset under management fees until you sell the business. Okay? Now, when you sell your business, the first 90 days is when you are the most vulnerable, because this is where the sharks are lurking. They want to encourage you to donate your assets to them so they can manage the funds. Now keep in mind, a wealth planner has done this 10 times this year. This is the first time you have sold a business. So they're the expert, you're the amateur. So you need to arm yourself to be prepared for what's coming next. Because as a business owner who has just sold a business, you are emotionally compromised. You might be experiencing guilt, you might be experiencing fear of loss, you've got this liquidity event, and most importantly, you might have a loss of identity. Your purpose was the business, and now you've lost that, and you're now in a fear of loss situation. That is why you are prime target for a wealth planner. You see, you are currently in the most exploited group in wealth finance. This is the wealth purgatory between a retail investor before you become a sort of 100 million net worth to a family office. So you're in the in-between section. This is where the people feel they need a wealth planner and feel they need the guidance. So it's very important to understand that, and it's very important to understand what they are going to offer you. So you might have the fear of loss and the loss of identity from selling the business, but I'm here to tell you that you're not out of the game yet. You have a new purpose. Your new purpose is now the chief investment officer of your family and of your wealth. So now you need to learn the rules of investing, the rules of the game, so that you do not fall victim to the financial jargon and financial confusion that the finance industry is experts at throwing at you. Now, you as a business owner, you have been rewarded for taking action and making quick decisions. This is the first time in your life where making a quick decision will work against you. I'll be the first person to tell you the correct thing to do for at least the first 6 months is nothing. There is nothing wrong with just parking the money into T-bills or a high yield savings account, a money market fund, somewhere that is highly liquid to access the funds and safe. Let's not worry about investments, worry about this and worry about that. Right now, it's just to get your mind clear and just taking it one step at a time, because you're going to be pressured to make a decision. And the right decision is no decision until you have your head in the right space and you know exactly what you're up against. See, when you deal with wealth planners, they're going to treat you like a lottery winner. They're going to say, well done on selling your business, give the money to the adults, go play golf. No, okay. No, you did not sell this business to become a pensioner. That is not why you sold the business. You are now the manager of this wealth. Otherwise, you're donating 30 to 40% of that over its lifetime to the wealth planners. Okay? It's very important to understand what they'll offer. They're going to offer like a 60-40% portfolio. So 60% in index funds, 40% in bonds. Typically, mathematically, in the current economic climate, this is losing to inflation. On top of the fact that it's losing to inflation, you're paying a 1% asset under management fee. It sounds like a tip. It's actually 30% of your wealth, 40% of your wealth over the next 10, 20, 30 years. So it's not like you're going to lose the money overnight. It's a slow erosion of the wealth. Okay? You didn't work all the 20 years building this business to lose 1% of your wealth every year. Mistakes scale with wealth. A mistake when your net worth is $1,000 doesn't hurt as much as when your net worth is $10 million. So you can't afford to make a mistake. So the wealth planner is incentivized to avoid lawsuits. How do they avoid a lawsuit? They give everyone the same portfolio. 60% in index funds and ETFs and bonds. Answer me this question. As a business owner, imagine you had a wealth planning company and you had 1,000 clients. Could you really give them all unique portfolios? How would you keep track of all those portfolios? If you have really concentrated stocks, they're changing all the time. It'd be physically impossible to manage it. Impossible. It'd be far easier just to give a copy and paste portfolio to all your clients. That way you get the best of both worlds. You avoid lawsuits and you avoid the extra work. We're looking at their incentives. The asset under management business is one of the best financial businesses I've ever seen. It has an infinite return on equity. You see, a bank is limited on how much loans it can give out. It cannot just lend infinitely. It must have a certain amount of liquidity in their assets in the balance sheet. But if you're just managing people's assets, you could be managing $1 trillion worth of assets. You don't need to have any provisions for that because it's all segregated security. So they have an infinite return on the more assets they're managing, the more money they get, despite whether the market's up that year or the market's down that year. They still get paid. So that is why this is so profitable for the wealth industry. And that's why you need to be aware of this, because you do not need to pay this asset under management fee. You can manage your own assets yourself with your own institutional broker. So they might think, okay, you're too savvy and you understand that you can just buy the S&P 500 if you wanted to do that. So they're going to throw some other things at you. They might offer you private equity. Private equity is illiquid. You're tying the money away for 7 to 10 years. It basically launders volatility. So they can hide the volatility, whether the asset is up or down. The private equity firm can disguise that. Another thing to be absolutely aware of is most private equity firms do not even beat the index. The gap between a tier 1 private equity firm and a tier 2 private equity firm isn't the same as like the fund manager industry. The gap is violent. A tier 1 private equity firm have a queue of billionaires waiting to give them money, desperate to give them money, because they are the ones that find the next Google, the next Nvidia, the next Apple, because they have a completely different business model than the tier 2 private equity firm. The reality is, if a private equity firm is coming after you, they're just must not be that attractive. The best private equity firms are the ones you can't get access to. If they're easy accessible, they're probably not that great. They also can have capital calls. So that's like a margin call for private equity. Yeah, they just ask you, okay, we need the extra liquidity. That's terrible. You do not want to be capital called from a private equity firm. That happens. The IRS will ask you for taxes on any profits from your private equity, even if you have not received the profits. The company might have made a profit, reinvested it, you will still get a letter from the IRS asking to pay tax, even though you have not even been paid the profits. This is just the brutal reality of private equity. And not only is this true, I've got a confession from the victims. The JP Morgan Family Office report has 40% of family offices are invested in private equity, yet complain about having no access to liquidity. So it's like shooting yourself in the foot and complaining the foot is sore. Another strategy the wealth planner will throw at you is the Roach Motel strategy. So they'll say that, okay, actually, you know what we do here? We buy all 500 companies in the S&P 500 individually, not just an ETF. They like to confuse things. We'll have 500 companies. This way you'll save on tax. We will manage it. We will sell the losers and keep the winners. This sounds like a good thing. It's actually a customer retention strategy disguised as tax optimization. Because what this means is if you ever had to transfer your portfolio away from them, you have 500 stocks, 500 dividend payments, 500 proxy vote requests by email, and it's an admin hellhole. So we don't want this. Ideally, what we want to do is we want to have a portfolio that is hard assets. Okay, we want to have, gold, Bitcoin, solid monopoly companies that have unbeatable pricing power and moats, because financially, mathematically, private equity and the index just cannot beat a blue chip tech monopoly or prime real estate. Okay, once you understand this and how simple it is, then you'll realize that you can do this on your own, and you don't need to rent someone else's competence or pay for your own insecurities. It's an emotional decision from the fear of loss, and you don't want to have that. You want to be sovereign and able to do this on your own, because the big factor is you have sold a asset, your business, which destroyed monetary inflation. Why would you trade an asset that beat inflation for an asset that loses to inflation? Because monetary inflation is what we want to focus on. The CPI is the inflation you've been led to believe. The cost of survival is inflation. The cost of survival is not the true inflation. The true inflation is monetary inflation. The more dollars that get created, the more the S&P 500 goes up, but the weaker the dollar gets. So we need assets that can outperform monetary inflation, because more dollars are going to be created because the US is in a deficit, so there's no choice but to create more dollars. More dollars is higher inflation. The currency is getting weaker, assets are going up, but we need the assets to go up faster than monetary inflation. That is what the game is about. So, more videos on my channel. Have a look and leave a comment, like and subscribe.